Everyone says start investing early. But how do you start when you have no clue what to buy? Let's make this simple. No jargons, no fancy goals. Just the products that actually build wealth. First, let's understand the building blocks. There are only 3 types of products that matter when you're starting out. Equity, debt, and gold. Think of them like teammates. Equity builds growth, debt provides stability, and gold protects you when everything else is falling apart. Your entire portfolio is just a combination of these 3. So here is the 70-30 beginner blueprint. If you're below 35 and starting from scratch, then start with 70% equity and 30% debt. Gold can come later. Let's talk about the equity portion. Don't overcomplicate it. You can start with a 50% exposure in a Flexi cap fund and 20% in a large cap fund. That's it. You now own India's top companies managed automatically. Now for the debt portion, keep it simple. 15% goes into a short-term or a corporate bond fund and 15% goes into liquid funds for safety and emergencies. Congratulations, this is your foundation portfolio. What you've got to do is build it with SIPs and not luck. The biggest mistakes beginners make is waiting for the perfect time to enter into the markets. The truth, there is none. Start a monthly SIP. Even 3 to 5,000 is more than sufficient to get the habit going. Increase it by 10% every year as your income grows. You don't need timing, you need time. Add gold only when you've built the core strength. Once your portfolio crosses 2 to 3 lakh rupees, add a small component of gold, say 10 to 15%. Gold stops you from becoming poor when the market crashes. You can take up a gold mutual fund or a sovereign bond if available, and if it's not trading at a premium, you can even go for a gold ETF. Now the most important step, rebalance once a year. If your equity shoots up and becomes 80% of your total portfolio, shift some of the profits to debt. If equity falls to 60%, add some more. This simple habit forces you to buy low and sell higher automatically. The next step is, as you grow, you evolve your allocation. Your portfolio isn't a tattoo. It's a living thing. As you age or your corpus grows, develop more stable strategies. Slowly shift to 60-40 in your 40s, a 50-50 allocation in your 50s, and keep a 10-15% exposure in gold throughout. This makes your portfolio stable, predictable, and still growing. When you hit goal numbers like 1 crore, 2 crore, 5 crore, whatever your goal is, you can shift to more complex strategies, which we will discuss in later videos. So let's talk about some mistakes beginners make while executing. Let's end this with what not to do. Don't pick 10 random funds. 3 to 4 smartly picked funds are enough. Don't stop SIPs in a crash. That's when real compounding begins. Don't mix ULIPs, LICs and mutual funds. They are completely different tools. And don't check NAVs daily. Monthly, quarterly or yearly is the way to go. A portfolio that wins isn't one that chases performance. It is the one that survives each and every cycle. Imagine if the stock market doesn't grow for 10 years, what will your portfolio do? If it can survive the storm, that is the real magic. Forget complicated advice. Every great portfolio starts simple. 1 Flexi cap fund, 1 debt fund, 1 SIP. Build consistency first, compounding later. Because in the world of investing, the best start is to just start. If you want me to help you along on the journey, there will be a link in the description. Do check it out. And follow Arthnova for more such videos. See you. पीस नहीं टूटा, सिर्फ कैप उड़ के गई है.